Hey Andrew, how are you, man?
Yeah, fine. Yeah. How you doing?
Uh, Looking forward to my break next week to get away from the day-to-day grind and um, start getting my teeth into this crypto system properly. So
Yeah.
uh, let's just wait until a few people turn up, and then
Yeah.
and then I'm gonna. So, g'day, Michael. How are you, man? So today the plan is I want to explain the basics of the crypto market and explain the basics of momentum systems. And I want to flesh out from first principles how momentum works and how the position sizing works, just so that you guys have an ability to do this stuff from first principles. Um, so,
Yeah.
so
Sounds
you
good.
haven't do it from first principles. I'm just going to leave it a couple of minutes until other people turn up.
Sure.
Yeah. Right, I'm going to grab a drink of water before we start, and a minute. All righty. I'm going to share this group. All right. So let's start with some basics here. If we go back in time, looking at Bitcoin, way back before anyone had heard of it, when it was like under $10. This thing shot from $10 to 268, back to 62, up to 1,000, down to 110, up to 20,000, down to 4,000, up to 13,000, down to below 4,000, up to 20,000. What do you think is the characteristic of this market? Big swings, right? Like very big swings. So the reason for this is two things. Thing one is it's constrained supply. So these are mathematically constrained. There's only 21 million Bitcoins. That's all they're ever going to be. And people lose them all the time. They forget their password, you lose your coins. And so it's it's an asset where supply is depreciating. What do I think about Bitcoin being the future of money and all that? I think it's probably bullshit and a pipe dream. But what I do think about Bitcoin is that it kind of looked like a scam, 10 years ago, but every year that it doesn't fall apart, it looks like less and less of a scam. Every year that professional investors start to look at things like ETFs and proper custody chains, and every year it becomes more mainstream. It hits the financial news more and less of the idiot crypto guys. Every year that it doesn't fall apart is a year in its favor. So the constrained supply means that these massive big pumps are baked in. It will always, in fact, any crypto will always have these massive runs. Sadly, it will always have these massive drops. And why is that? The massive drops are caused by a very superficial way to look at a market is by looking at the size of the market. A more intelligent way to look at the capacity of a market is by looking at the size of the doors into the market and the size of the doors out of the market. So crypto, you have a situation where there's hundreds and hundreds of crypto exchanges, but you can't just exchange your US dollars or Indonesian rupiah or Thai baht or Australian dollars for crypto as easily. And why? Because most countries are concerned about money laundering, and they want you to do a bunch of proper bank account stuff to get a crypto account. So I've got a bunch of crypto accounts, and getting registered for those was a prick of a thing. Getting registered in a non-fiat crypto exchange, like for example, Binance is the biggest one, is a matter of seconds. So you can set yourself up a Binance account. You can only deposit in other cryptos. And then you can start to trade all these cryptos. So the door in and out of the crypto market is very, very small. Like only a fraction of the total crypto volume, which is measured in billions, actually goes through doors out of the crypto market. So most of the money sloshing around the crypto market is money that's already been made in crypto and kept in crypto and sloshed back into a different crypto. So we see this behavior. Check the date. December 17, Bitcoin made its all-time highs. What happens when Bitcoin kids get super rich, they start to take their winnings and play them on the casino wheel of other Bitcoin exchanges. So if we look at, if we look at Ethereum, this is the same month, December 2017. The month after Bitcoin hit its all-time highs, it went from $743 all the way up to $1420. So it doubled in a month after Bitcoin hit its all-time highs. Let's look at some others. Bitcoin Cash started after then. Oh, what's another one? So Neo, December 17 was $73, got as high as $200 in the last month. Icon ended December 17 at $5.34, got to 13. So this is a typical thing, right? Like at the end of a boom, let's look at some really terrible coins, like Verge. It's just well, this spiked before then, but you can see the level of boom and then bust that these smaller coins are capable of, and it's because these profits in crypto have to go somewhere. So you've got these guys who held crypto since it was under $100, and I know some of them personally. Crypto gets to 20, Bitcoin gets to 20,000. These guys are just like looking to double and triple down their winners. They're diversifying into different coins. They're reading about new projects, and they convince themselves that they've hit 1,000 to 1 winner and they're about to hit a bunch of new 1,000 to 1 winners. And what they neglect is that the doors out of crypto are very small. So most of them will take their winnings and store them either back in Bitcoin or in tethers, which are a topic for another day. So anyway, so what we see is this behavior when things start to go up in crypto, they have a very, very strong tendency to go up. They start to go up, they have a strong tendency to go up. They start to go up, they have a very strong tendency to go up. So we want to design a system that gives us this bit, doesn't give us any of this little shitty bit, and leaves us not sticking around for this bit. That's the goal, right? So how do we do that? We do that with a concept called momentum. And momentum is a very rigorously...
Nuggets? What do you want, Izzy?
Momentum is a very rigorously tested phenomenon
Riley, what do you want?
In regular stock market systems. And a significant chunk of institutional money trades using momentum systems. So momentum is a very simple thing. It comes from a 1993 paper by a guy called Jagadish and another guy called Titman. If you just look up momentum paper, actually I'll post it in the group. And so what it is when you measure the returns of a stock for the last 3 months, they are predictive of the returns for the next 3 months. So something that is, so it's literally a momentum effect. So the strongest things in the past 3 months, and 3 months is about the sweet spot for stocks, and we're going to get to that in a minute, like what's the sweet spot for crypto, are strongly predictive of what's going to outperform for the next 3 months. Now, there's a wrinkle to it. Stock markets also have what's called a mean reversion effect. If something pumps, it's likely to pull back over the next month. So for stocks, generally the optimum momentum period is 90 days excluding the last 30. And that's how most institutional systems do. So the way momentum systems work is you develop a ranking methodology for your stocks, and then at periods you hold a portfolio of the strongest stocks. You do not use stops. And a couple of things first about this. The psychology behind it is that everyone loves a winner. So, for example, if you own Amazon, you bought it here. This big pullback from 60 down to 24, that's no big deal if you paid $7 for it. If you paid $60 and it goes down to 24, that's a big deal. So people tend to sell things that show them a loss and hold things that show them a winner. So when Apple started to become unequivocally the strongest thing in the world, no one's selling out here. And you can see what happened is that no one sells out, no one sells out, no one sells out. Even the pandemic couldn't really damage Amazon. The winners take all. And if you think about the structure of our economy, the structure of the economy right now is very much a winner-take-all economy. Second prize is a punch in the face. Second best social network is Twitter. It sucks. Second best online retail, I don't even know what the fuck it is. Like it's Amazon and then Daylight second, right? That's the way our economy is structured. And why? Because capitalism, it's a winner-take-all system, and eventually you leave it running long enough, the winners will take absolutely everything. This is not dissimilar to crypto. If you think about the crypto markets, is crypto a complete fraud and a scam and a waste of time? Really depends on, does it have a use case? And a lot of the use cases that are talked about with crypto are nonsense, but there's a couple of very real ones. So if I think about the legitimate use cases for crypto that can't be argued away, what percentage of your assets do you own that cannot be seized by the tax office? What percentage of assets do you own that cannot be seized in a divorce? What percentage of assets do you not need a bank account to own? What percentage of assets can a North Korean citizen subject to sanctions own? So what percentage of your assets could an absolute criminal like a drug dealer or a drug trafficker use to buy and sell easily? And if you think about it, Switzerland's dined out very handily for the last 1,000 years on exactly that market. And I believe that cryptocurrencies ultimately will eat Switzerland's lunch. And there's been a bunch of other fake Switzerlands, like St. Kitts and the British Virgin Islands and Luxembourg and all those places, second-rate off-brand Switzerlands. And at the very minimum, crypto is going to eat their lunch because it's cheaper. I can transfer $1 million worth. I can transfer $1 billion worth of crypto to someone else very simply, very easily, at very low fees. And it sort of invalidates a whole pile of the tax avoidance industry, which is going to come under pressure in the long term. So does crypto have a future? Yes, it has a future. Is it going to take over the world and take over banking? Maybe, but that sounds like a very long shot thing to me. To me, crypto is something that everyone should have 1% of their assets in, simply because no one can steal it from you. Well, people can steal it from you. Obviously, there's lots of steals in crypto, but no government can take it off you without a whole pile of problems. or unless you're negligent, and it's prone to bubbles. So what I want to do is build us a system where we are holding, if we're talking about crypto, where we're holding the crypto equivalents of Amazon, Netflix, and Facebook all the time. How do we do that? The first thing we do is we develop a ranking methodology. And when we talk about building trading systems, the concept is important much more than the actual maths that you're going to use. So, for example, so if I put a linear regression line on this and measure the slope of the linear regression line, this line has a higher slope than Walmart, right? Amazon is objectively better than Walmart, stronger. And that's not a question of technical analysis. That's a question of this number. What's the slope? So, the principle behind momentum systems is that everyone loves a winner. If you're on Amazon, you're unlikely to sell it because you love Amazon, because you own Amazon, and that's fucking awesome for you. I wish I owned Amazon. And because you're unlikely to sell it, and other people are likely to covet your Amazon stock, there's likely to be more buyers and less sellers. And that particular thing is that combination of more buyers and less sellers is giving it a statistical likelihood that it's going to go up even faster than it did before. Now, if you look at what's going on here, sure, it went up, but it's only, you can see clearly it's going up faster than it did before. You can see that effect in play. Like when people realize, fuck, if you don't hold some Amazon in your account, you're missing out. And we see that in crypto time and time again. There's very weird primate social dynamics in the crypto crowd. If you've ever been onto any of their forums or any of their shit, they all love this one and hate this one, and they love this guy and they hate that guy. And if this guy shills this, they love it. And if he hates it, they hate it. It's tribal. In fact, the level of bias in there makes, political supporters of either side look pretty calm and rational. So you have a situation where, for example, there's certain crypto coins that are obvious out and out scams. And their supporters are so virulently in favor of these cryptos that they will not sell them, despite the fact that they're scams. So they go up. And that behavior is a psychological bias, which we all have, which can be exploited. And what I'd like to do is design a system to exploit it. So here's how. What sort of system are we going to build? Well, let's pick let's look at the coin market cap top 100. Look at weekly. When do you want to hold this one, for example? We don't really want to hold it here. Like, even though it's made money, it's tied up your capital from June 19 to July 20 to make just a tiny little bit of money. Like, even though it's made money, tying up your capital for that long is a big mistake. What we're trying to achieve is to only hold this coin in this period and then fuck it off and get on to the next one that's doing that. And what we would like to do, ideally, is have our capital only in the coins that are doing this. So, which brings us to a question. What is the ideal amount of coins to hold? And that's a question that was asked and answered by Ray Dalio, who built his amazing hedge fund on it. And he's done the maths. And the maths is between 9 and diversification is one of the best free lunch, is one of the only free lunches in finance. So between 9 and 15 is optimal. You don't get much benefit beyond 15. You don't get much, there's not much benefit in holding 100 coins compared to 15 coins. Everyone understand that? So the sweet spot is between 9 and 15. So let me just see if I can find. There should be an image somewhere over that. All right. So this is the number of assets in portfolio. These are highly correlated, so let's call them 80% correlation. So our curve is looking something like this. So if we hold, even if we hold 5 coins, we're getting a significant benefit of diversification. We're not getting much more benefit by holding 20 because cryptos are highly correlated. And that's one of the problems of crypto that we're going to have to design our system around. If we were talking about assets which aren't highly correlated, like say bonds and crude oil, gold, emerging market bonds, blah, blah, blah. If we're talking about things that were really uncorrelated, 4 or 5 coins, 4 or 5 things at once wouldn't give us nearly enough diversification. We could get a much better risk-adjusted return by jacking that out to about 15 or so. So because cryptos are highly correlated with each other, and what that means is that when one goes up, they all go up. When one goes down, they all go down. The sweet spot for us is going to be holding around 5. Now, why 5? Maybe a few more, maybe a few more. I doubt any less. And the reason is simple. What we're trying to catch is this move from 10 cents to 78 cents. What we're trying to catch is this move from 23 cents to $3. We're not interested in averages. We're interested in finding this, in identifying early this lucky winner. And we're talking about riding its luck to the beach and then jumping off very quickly. So the more that we have, the less influence, the more coins that we have in our portfolio, the less influence of luck. So that's very important to understand. If we have a big winner in our portfolio, that goes, this is XRP, it goes from 20 cents up to $3.50. That's great if it's a fifth of our portfolio. If it's 5% of our portfolio, it's not a big deal at all. We are trying to exacerbate this effect, not minimize it. So compared to stock systems, which typically hold about 20 different things or more in some, and I'm just going to digress a bit. The S&P 500 and the Dow Jones 30 are actually momentum systems of themselves. And so why is that? The Dow Jones, the S&P 500 is the 500 biggest companies in America, right? If your company starts to suck, it's no longer one of the 500 biggest and they toss it out. If your company starts to do really well, like say Tesla has, they just added it to the S&P 500. So it's a constant list of the winners. So if you wonder why the S&P 500 always goes up most of the time, it's not because of statistical analysis. It's because the S&P 500 is cheating. They're only showing the winners. And so what we want to do is build a very, very small version of an index fund that holds only the winners in crypto and holds, instead of 500 like there is in the S&P 500, we're talking about 5. Enough that we can get really a lot of benefit from the big winners as they come. Make sense for everyone? Now, the inherent problem that you run into immediately is, let's say we've got 2 coins. We've got Bitcoin, which is $20,000 or $19,000. We've got this other coin, I don't know, Polkadot, which is $4.70. If we hold 5 coins and we hold equal weight, and we've got $100,000 in our portfolio, and we hold 20 grand worth of this, and we hold 20 grand worth of Bitcoin. We've got 1 Bitcoin and we've got 4,000 Polkadots. Bitcoin is hurting our portfolio, not helping it, because it's pretty hard for Bitcoin to go from 20,000 to 100,000, but it's pretty fucking easy for Polkadot to go from, well, it already went from $2 to $14. So it's entirely possible for it to do that again, right? It's entirely possible for Polkadot to triple. It's not, but for Bitcoin to triple and become 60,000 would be an amazing Herculean superhuman feat. So if Bitcoin is one of the strongest coins in our portfolio and we hold it, we're doing ourselves a disservice by holding it. Because even though Bitcoin might be the strongest coin, we make more money by holding one of these little shitters like, this isn't even a strong coin, but like this one, which has gone from $5 to $25 in a year. So what the solution to this problem, again, when I design trading systems, I like to steal the mechanisms that smarter people than me have used. So I'm going to use what's called volatility weighted position sizing. And so the way this works, let's get some standard examples here. Okay. So the formula for volatility weighted position sizing is the number of shares or the number of coins equals your account value times your risk factor, and we'll talk about risk factor now, divided by ATR. And ATR is just a proxy for volatility. Some momentum funds use a smarter momentum model, but they really don't make much difference, to be honest. So risk factor is the amount of influence on your portfolio you want it to have on a normal day. So a 70 basis point, let's do some examples. So 70 basis points is my rough guess as a starting point. Obviously, we're going to test a bunch of different things. Okay, so let's say we have a $100,000 account. At the time I did this, it was a 10.65 Bitcoin thing. So right now, Bitcoin's 19,000, so that would be 5 Bitcoin. So how many Neos do we buy if Neo makes our ranking list? We've got 5 Bitcoins by the, actually I changed it to 0.05, by a risk factor of 0.05 divided by the ATR, which was 0.0042. Actually, I'll just use my old. And so when we work that out, the amount of coins that we buy is 1,267 NEOs at $10.92, which equals 13,835 out of our $100,000. So you can see that 100 divided by 13.8 is going to be roughly 7 coins in our portfolio. If I do the same example with Ethereum, it's going to be 24,000. If I do the same example with TRX, it's going to be 12,000. So how do momentum systems work? Two-step process. Step one, you develop a ranking system of everything that you want. In our ranking system, I'm going to suggest excluding Bitcoin because we're trying to target, multi-100% returns here, and it doesn't make sense to use Bitcoin to target those. So we develop a universe of coins. I'm going to start with the top 100 coins. I'm going to exclude Bitcoin, and we trade once a week. We don't use stops. Now, stop losses are problematical in the crypto market for a couple of reasons. First of all, they move like let's look at actual days. This fucking day. If you have a stop loss, if your stop loss was at 4,000 and Bitcoin was at 8,000, you would have a reasonable right to feel safe. And yet a couple of hours later, your stop loss is hit. For this situation, and what causes this is exactly what we talked about before. The idiots, when they look at crypto, they're looking at the size of the market. The size of the market is $340 billion. The volume is $28 billion. But that's all bullshit. What really matters on a bad day is the size of the doors in and out. Now, the size of the doors in and out are the size of the doors in and out to fiat money, back to real money. So most cryptocurrency volume, the vast majority of it is trading from this to that, to this, back to Tether, to this, to that, to this, to that, to this, to that. Very rarely do people cash their chips out of the casino. Some do, but it's just such a tiny percentage that when everyone at once rushes for the exits, crypto can do very bad things. So for that reason, stop losses are an incredibly bad idea, like a really bad idea in crypto. But you need risk control in a system. You can't just like buy and hold and buy and hope. Like that's retarded. Like that's literally an idiotic way to trade. So what's the solution? The solution is pretty simple. So first of all, before we buy any coins, we want to run an index filter on the markets. And you only buy when the index filter is positive. So for example, it doesn't matter what coin you bought from 2018 to here, you are going to lose money. Doesn't matter how you do it, doesn't matter it doesn't matter how good the project is, doesn't matter anything. So we want to have a system that stops us from buying here, but lets us buy for here, and lets us buy for here, and stops us buying stuff into the teeth of the hole. That's a logical proposition. So how do we do that? We use one of the basics, the basic ways to improve any trading system is by running an index filter over it. So let me show you some index filters that professional systems use, and you're going to be surprised at how fucking retarded they are. This is one of the most common index filters is a 200 moving average. It's a little simple for my taste, but the idea is that we hold the strongest coins from here up until here, and then we stop buying and we don't start buying coins again until here. We get a little bit of whipsaw around here and here. We don't buy anything down here, and we're a bit late to the party and we buy here. So is this a good index filter? Well, it's not perfect. That's clear, right? Like it's got some shitty periods. But what are we really trying to do with crypto? We're trying to catch this period of time where everything's gone bullshit strong, and this period of time where everything's gone bullshit strong. And we're trying to avoid this period of time where you got clown raped. We're trying to avoid this period of time where you got clown raped. So even though this is just a 200 period moving average, the dumbest possible shit you could possibly come up with, in terms of the job it does a fucking yeoman's job of keeping you in when you want to be in and out when you want to be out. So let me show you another common one. Where is it? Sorry guys, I'm a bit retarded today. So another really common index filter is moving average crossovers. Now, moving average crossovers have no predictive value, but you can see they kept you in crypto from here all the way through here. You copped a bit of heat, but overall, it did what it's supposed to do in keeping you out from here, keeping you out, keeping you out, keeping you out, keeping you out. Got you back in here. Got you in at the right time. Got you out. You copped a bit of heat. Avoided some bad. Avoided some bad. Not really. Still got some of the bad. So it did a slightly different, not necessarily better job. Now, we can improve on this as an index filter by using the one from our scalping system. I like to reuse parts of things. There's a couple of other ones. But what I want to point out is that it's the concept that makes the difference, not the actual numbers. If you're building any trading system and it depends on you having this perfect thing, then your system idea sucks. So the way to build systems from the ground up is to start with the simplest, stupidest iteration of bullshit that you can possibly come. The simplest thing that actually meets the concept that you're trying to do. So we'll probably start with a 200 period moving average, to be honest. The dumbest shit we can. If it works on that, then we can improve it, but that's a nice place to start. So how does it work? We're going to start off buying coins 1 day a week. Which day? Doesn't matter. Like pick Monday, pick Wednesday, pick Friday. Doesn't matter. Why 1 day a week? Why don't we do it every day? Well, a couple of reasons. Firstly, transaction costs are very high in crypto. And the exchanges are Wild Westy type situations. We don't want to be having a fully automated algo in and out, 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 day after day. It's a nightmare to keep track of. If we build a system that executes once a week, that you can double check what the algo has done with a spreadsheet, that you can do the math yourself and not rely on some computer telling you what to do, then in my view, we're a long way in front. And take a look at where the real gains are made. The real gains are made by riding this puppy from 4,000 to 14,000. They're not made by zigging in and out every day. And in fact, day trading cryptos is one of the worst ideas you could possibly have. So how does it work? Step one, develop a ranking methodology of all your coins. I'm going to use linear regression line just because it's the simplest shit that actual professionals use. What period am I going to use for linear regression line? I'm going to start with 90 days, excluding the last 30. Why? Because that's what the vast majority of professional momentum systems use. We might have to make it a shorter period because crypto markets move faster. Which brings us to an interesting proposition. How do you optimize the period? So what we're looking for when you optimize parameters on any trading system is you're looking for one good number in a forest of good numbers. You're not looking for, like if we had a situation where 90-day momentum was amazing and 70-day momentum was terrible, then I would say the whole concept of momentum is flawed. It should be a situation where any reasonably chosen, the way I think about it, the exact phrase I use in my head is any reasonably chosen parameter should be reasonably good. It shouldn't be terrible. So you should have a forest of decent numbers. Now, when you choose the parameter that you're going to use for your system, pro tip, never choose the best one. And why? Because when you choose the parameter that worked best in the past, the only fucking thing that we know about the future at all is that it's similar to the past, but not the same. So when you optimize for exactly what the past is, by definition, you get it wrong going forward. This is a big mistake system builders make. So we develop our ranking methodology. We're going to start testing with 90 days momentum, excluding the last 30. The first thing we do is we say, is our index filter positive? If our index filter is positive, we're going to start at the top of our list of coins and we're going to buy them volatility weighted, like we suggested before, using that formula that I showed you before, until our account is used up. Make sense? Okay. Once a week, we're going to do two things. We're going to do position sizing rebalancing first, and then portfolio rebalancing second. So, actually, that's the wrong one. So let's say we're trading TRX. And it looks like this. And we've held it all the way up to here. Almost certainly in this period, under any ranking methodology, this would be the strongest coin in the world, right? Like it's gone from 4 cents to whatever it's gone. It's like bullshit strong. So we've got our position size, which is based on this divided by an ATR value. look at what's happened to our ATR value. We bought it here, and the ATR was 0.00097, but here the ATR is 0.000597. So ATR is like 10 times what it was. So if we keep, so the purpose of volatility weighted position sizing, the clue is in the name. What we're trying to do with volatility weighted position sizing is make sure that whatever we hold, they have approximately the same influence on our portfolio returns. So what we don't want is a situation where all of the returns of our portfolio come down to this one super thing that's going through the roof, and everything else is either a break on performance or so small that it doesn't matter. We want to have our positions sized so that we're holding a certain amount of winners, and all of those winners roughly contribute equally. So what we're trying to do is balance luck and caution. Make sense? So the first thing that we have to do is do position sizing rebalancing. So the first thing we do is calculate our theoretical new position size based on our new ATR value. Our new ATR value is going to say, oh, fuck, you know, before you were holding 764,000 TRX coins, and now, because ATR has gone up, you're only supposed to be holding 200,000. So what do? You're supposed to hold 200,000. You are holding 764,000. You sell 564,000. Now, what is that in real terms? In real terms, you're banking profit. When are you banking profit? You're banking profit on a volatility spike. Now let's see how that plays out again and again and again. Do you want to be, if you hold this coin here, do you want to be banking profit on each successive volatility spike? I think you do. You don't want to be holding it from here and then let it go back down to here. So in effect, anytime you have a high volatility winner, which is almost certain in crypto, far more so than in stocks, in an increasing volatility winning position situation, you are de facto scaling out of your position all the time, banking it, and you have more funds in the kitty then. So after you've done that position sizing rebalancing, the next thing that you do is go to your coin list again. And okay, we want to hold the top 7 coins. Right. If any of your coins fall out of your top list, you sell them. So if something was the strongest coin, it's out of the list of strongest coins, it gets sold, that money goes back into the kitty. Once you've worked out how much money is back in the kitty, you then go back to your list that you made with your linear regression line, and you start at the top and say, okay, I already hold this one, already hold that one. Number 3, I don't hold. Better buy that. How much do you buy? You buy volatility weighted. Oh yeah. Fourth one, okay, I already own that. 5th one, I don't own that one. I better buy that. And you keep going until you run out of money. So, a couple of things I want to point out. Doing the portfolio rebalancing de facto gets you out on volatility spikes, which is where you want to get at. The second thing I want to point out is that the requirement that you can only buy if your index filter is positive on the index as a whole. And we could use Bitcoin, we could use market cap. This is market cap excluding Bitcoin, which is the one I'd like to test first. It's called Total 2 on TradingView. So what this means is that if ever we get below our index filter, when we cash out of coins because the volatility is spiked or because they're no longer in the top list, it de facto goes to cash and it stays in cash. So what this means is that we're holding cash here and then we're buying back in here. And here, as we sell out of our coins, we're buying new coins. So the idea is that we're constantly refreshing our crop of what we're holding with the very strongest ones. As they stop being the strongest ones, we sell out of them. And we do that without emotion, 1 day a week, with an algorithm that you can check yourself. And my idea is I'd like to fully automate this with the APIs of the major exchanges like Coinbase and Binance are the first two that I'm working on. So anyway, I hope this gives you an idea of how it's going to work and an overview of the numbers. Obviously, there's a bunch of details to work out, and I hope to have you all involved in the testing, and we're going to do a number of these webinars, and I'm going to show you like what works, what doesn't work. Then we've got a number of decisions about what do we use, what market do we use for the index filter? Do we use Bitcoin? Do we use crypto market cap? Do we use market cap excluding BTC? Does it make any difference at all? Yeah, we got a bunch of decisions to make, and I hope to let the data decide for us and not opinions. And yeah, I'm excited about the process, and I think this is a market cap of the crypto market. We are here, and I think the odds are very strong that we're going to get at least to here and possibly to here. And if that happens, if we see another crypto bull market like we did in 27, and believe me, all signs are pointing to that now, it's going to be worth us putting the effort now to build a system so that we don't get carried away with emotion when it gets up here like everyone does, like we will, like I did last time, like everyone's going to. So anyway, so that's my idea, and I want to have you on board in the development process, and yeah, it's my absolute pleasure to serve you guys. So, okay, so before we stop, John's asked a question about linear regression. So let's talk about linear regression. Linear regression is, so if I put a moving average on this, that's a technical analysis concept, right? Linear regression isn't a technical analysis concept, it's a mathematical concept. It's solving for a line of best fit. So the built-in one has this weird thing, but this is the line of best fit. So this is a line that fits all of this price action for the period the best. And Dale has just messaged me. He says the ideas in the system are very similar to one of the momentum systems that are on Quantopian. Yeah, all momentum systems are almost exactly the same. There's the dirty secret of the professional trading world is that nearly all of these hedge fund systems look like the same fucking thing with a different wrapper on it. So linear regression is one of the very common, it's not the only one. So what we're doing is we're taking the slope of this line, which is written here, and we're saying that's a measure of how fast this thing's going up for this period. If I measure it against another thing, well, this slope is going down, but let's find one that's actually going up. This one's going down too. Well, yeah, I'd have to keep going to find one that's going up. So anyway, so we're doing our ranking based on the slope of this line here, and we're just ranking the slopes from 1 down to 500. Now, a couple of ways we can tweak this system. The smaller the coin, the greater the probability of it going from, like it's easier for a coin to go from 2 cents to $2 than it is for a coin to go from 10,000 to 20,000 to 100,000, right? Like it just is. So we can tweak the returns by altering our universe into smaller caps. And this is another dirty secret from the real stock trading, professional stock trading world. Most of the returns of this system will not come from which ranking methodology do we use or which trend filter do we use. Most of the returns of this system come from the universe that we select. If we're selecting a universe of very stable, high cap things that are unlikely to fall over, then our returns are going to be comparatively lower than if we're rolling the dice on a bunch of casino shitcoins. And so that's going to be one of the things that's going to be really interesting to play with and see how it affects. So anyway, guys, it's been my absolute pleasure to present this, and I'll post it on YouTube and you can have a look and blah, blah, blah. See you guys. Enjoy your weekends.